Good evening. Hello, everyone. Welcome to our new segment called Let's Talk Finance. I am Melva Payton Moore, the founder of FineOp Consulting Group, and this is a new segment we want to offer once a month. We want to address the questions of the members of our website and from shows we've done already, and we want to address these questions and I'm going to be doing them, just picking out a little piece and then coming to you once a month with just a little information, a little knowledge. Okay. So, what we want to talk about today, and before we get started on what I want to talk about, I just want to make a quick announcement. Tomorrow is our FineOp Focus Group. This is our second one. For those who have participated before, they could tell you that it's a wonderful learning experience. Tomorrow, we're focusing on what's your deal. That means coming up with where you want to go and really defining that and helping you create that process. So please, please, please join us tomorrow. But you can only do so by registering at www.fineopconsultinggroup.com. Again, www.fineopconsultinggroup.com. You can go there and register for this great free event. It's happening tomorrow evening at 6 p.m. We won't hold you long, but I promise it's a wonderful experience. Okay, let's get down to it. Let's talk finance. So there's been a question floating around because it's come up on a couple of our conversations, our town hall, another one of our focus groups, our first focus group that we had, and that is, what is a stock split? What happens when stocks split? We heard about Apple doing the 4-1 split. Tesla did a 7-1 split. What does that mean? And how does it benefit me? So basically, a stock split is when a company decides to split up, in layman's terms, their shares outstanding, right? So then say you have a pizza and the pizza is not cut at all. What happens in a stock split is they cut it up. The pizza is the same size. So in other words, the market cap or the market capital is the same size. What's the market cap? That is the amount of shares outstanding times the price. So say, for instance, you have 100 shares outstanding. It's $10 a share. So then before the split, your market cap is $1,000. Well, after the split, your market cap is still $1,000, but instead of it being 10 shares for $100, it is 20 shares for $50. So why would a company do that? What is this all about? Should I be excited? Well, first of all, the split is advantageous, quote unquote, or it applies to the shareholder, right? You have to already own the stock for your stock to split. How does that help you? Not really much other than price. But when you're looking at price versus value, the value hasn't changed. Just the price. So what a company does is to make it more appealing for someone like you or me to invest or to engage in investing. Instead of the stock being $100, it may look better or be more enticing to you, or you may engage more if you know you can get it for $50. Again, the market cap is the same. The pizza is the same pizza. It's still a large pizza. It's the same, but they've cut it up in smaller slices. So again, you own more, but the pizza is still the same. The market cap is the same. But again, it's advantageous to the company because one, it makes their stock more liquid. That means more people are buying it. So then they're able to sell more. They're able to get cash faster. So that's a reason that they would do it. Also, the cost of stock typically goes up. It goes up after that. Why? Because there's this influx of people buying it. So that's what makes it advantageous to them. How is it advantageous to you? Well, back in the day, I guess you could say it gives you more, but there are brokers like Robinhood or even Cash App that will allow you to buy fractions of the stock. So it's really the same. You could either, be there for the split or and try to buy at the dip where the price dips down, or you can buy a fraction of the stock. You basically own it the same thing because what you want is a piece of this pizza. So that is how it kind of is like six in one hand, half a dozen in the other, whether you buy the stock in fractions or to have the stock split. And then one more thing I want to cover before we go is a reverse split. So then you have stock that does the opposite. It doesn't split like a two, one becomes two. It splits in the reverse way where two becomes one, where your stock basically doubles in value. And this is something that companies do to make themselves look better to investors. They make the stock or the investment look stronger by having a higher price when they reduce the amount of shares outstanding or shares they offer. And then another thing that happens in the process is it makes it makes the company look stronger. It makes everybody look better. I don't want to over explain because then I feel like I'm kind of going overboard because we came to talk about the stock splitting, but in a reverse split, again, that's when you flip it the other way. I hope this has been helpful. Again, I want to invite you all, please, to join us tomorrow for our focus group, Find Out Consulting Group. We aim to provide financial literacy to underserved communities. And what we want to do, we're not calling you the underserved, but we want to give it to us, and we're giving it away. So join us tomorrow for this free event. Nice talking to you all. See y'all later.